Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me live at MarketSite is David Mazza. He's the head of ETF strategy over at Oppenheimer Funds. We're going to take a look at revenue weighting ETF investing. David, thank you so much for joining me over at MarketSite. And before we get into that, tell us about your role at Oppenheimer.
Yeah, sure. Happy to be here. My name is David Mazza, and I work in Oppenheimer Funds' Beta Solutions team to try to help research, develop, and create unique ETF strategies that all investors can use in their portfolios to help meet whatever particular outcomes that they're looking for.
So why should investors be thinking about revenue weighting in today's environment, and explain what revenue weighting ETF investing is?
Yeah, sure. So what's interesting is today's market has been quite a good one. Look back to last year. But this year, we've seen a bit more volatility come back into play. But at the same time, multiples, so meaning the price you're paying for a level of earnings or revenue, has actually increased significantly because we've been in a bull market since the start of 2009. Revenue weighting actually takes a much more disciplined approach. So as opposed to weighting an index by a company's market capitalization, it weights it by the revenues. So actually, what is a company actually delivering, not what investors expect it maybe to deliver in the future.
All right, so what are the similarities and key differences to revenue weighting versus a traditional market cap?
Yeah, so many of the similarities are the same. Really, it's looking to take advantage of the benefits that indexing can bring, which is low cost, diversification, tax efficiency. The challenge is when you weight by market cap, you can't control the weights, right? So stocks that run up in price that maybe become more momentum oriented become the largest weights in an index. Maybe those weren't the stocks that you wanted to buy. That wasn't the exposure that you wanted. Again, what revenue weighted does is every quarter we rebalance the portfolios back actually to the company's revenues themselves. So you're much more grounded, you're much more disciplined in your approach. Longer term, that can be beneficial.
All right, well, it's all about performance. How have these strategies done over the long term in comparison to market cap strategies?
Especially over the past 10 years, actually our three largest strategies, RWL, RWK, and RWJ, have actually outperformed their respective market cap weighted peer and their peer group. So they've been able to deliver really because what they're doing is avoiding the biases that can come with traditional market cap weighting, focus you in on that valuation that you're really looking for.
All right, well, it's perfect time having you over at MarketSite because there was a lot of news in the market this week about the Schwab survey that came out. More than 9 in 10 millennials see ETFs as vital to their investment strategies. Almost everyone in the survey, 96%, said they considered the passive index tracking securities a necessary part of their investment strategy, and 91% said ETFs are their investment vehicle of choice. Does this open up even more growth to the ETF industry, which has seen fantastic growth?
Yeah, it certainly has, but I actually think we're just at the beginning stages here, which is interesting. And these numbers are actually indicative of that because on one hand, ETFs allow you to build low-cost diversified portfolios. So if you are looking for the longer term, now you can actually get diversification in a really low-cost way with strategies, whether or not they're in the equity market, fixed income market, commodities, alternatives, what have you. But there's also another group of ETFs, and these are the more thematic ones, maybe somewhat more niche-y, but you can balance the potential for long-term with actually strategies that mean something to you. And you don't have to rely on picking the right stock, because of course that can come with some risks. Certainly if you pick the right one, you're pretty happy, but if you pick the wrong one, you might end up in a bad situation. So the diversification that you can get, even in a narrower space or more thematic ETF, can be beneficial.
All right, well, thank you very much for joining us at the MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.